Good afternoon, everyone, and thank you for joining us. You are attending the DBRS Morningstar Frontline Market Perspectives webinar on equipment leasing ABS. My name is Stephanie Ma. I am a researcher in our structured finance group, and today I'm joined by my colleagues, Sergey Masenko, an MD in our US ABS group and the lead analyst for equipment leasing, along with Du True, an SVP in our US ABS group. Before we get started, a couple housekeeping items. Please feel free to type in any questions that you may have throughout the presentation. You should see a question mark on the bottom of your screen. You can click and type in your questions. We will address your questions at the end of the webinar. An overview of today's presentation. We have a macroeconomic backdrop. We'll talk a little bit about ABS volume and then dovetail into delinquencies and losses. Comment briefly on the Inflation Reduction Act, and then open up the session for Q&A. Thus far, it's been a challenging year for the fixed income market in general against this backdrop of rising interest rates, inflationary pressures, and risk of recession. But by all accounts, the U.S. economy has continued to hum along. The job market remains resilient. In fact, this morning's weekly jobless report indicates that unemployment claims dropped 26,000 to 239,000, the largest decline seen in 20 months. Inflation is showing signs of easing. The CPI rose at a 4% annual pace in May, and that's the lowest reading in over 2 years. But the canary in the coal mine is whether the Fed will inadvertently send us into a recession as it tries to rein in inflation. We seem to still be in this rising rate environment, even though the Fed decided to slow the pace of rate increases by holding off at its last meeting a couple weeks ago. And mind you, this was on the heels of 10 consecutive rate increases equaling 500 bips. Fed Chair Jerome Powell has indicated that the Fed is likely to resume and increase rates again in the coming months. Neither inflation nor economic activity have slowed as much as many had anticipated this year, casting even more uncertainty regarding future Fed moves. With the benchmark Fed funds rate in the 5 to 5.25 range, most market participants are expecting 2 additional rate hikes later this year. July 25th is the next meeting, and if they increase rates at that meeting, that would mark a 22-year high. Obviously, it's a balancing act of possibly being too aggressive with the rate hikes and creating a much sharper than intended slowdown in the economy versus a soft landing. And then on top of that, we throw in the banking crisis into the mix. Small and mid-sized lenders were already beginning to pull back and then further tighten their credit standards in response. Nonetheless, the Equipment Leasing and Finance Association's latest monthly leasing and finance index reveals that equipment finance new business was up 1% in May, year over year, totaling $9.5 billion. Year-to-date cumulative totals are also up, albeit marginally at just under 1%, after a strong first quarter where equipment leasing volume increased by 4%, financing quieted down in both April and May. In an effort to keep investors more apprised of credit trends during this uncertain economic time, we launched our inaugural equipment leasing snapshot a couple weeks ago, which you should see referenced in a link at the bottom of your screen. This new semi-annual research series is dedicated to providing insights on general industry developments, as well as collateral performance trends underlying our publicly rated large and small to mid-sized equipment leasing securitizations. We will cover many of these trends, among others, during this webinar. We thought it would be helpful to kick off the presentation with a short discussion on equipment leasing, ABS volume, where securitization totals reached roughly $8.2 billion through the middle of this month. So Sergey, maybe we can delve into those figures a bit more and see where we saw that volume.
Yeah, sure, Stephanie. And good afternoon, everyone. Thank you for joining us. Stephanie, you're correct pointing out that this year has been far from ordinary. I think ABS issuance pattern reflects it to a degree. The year started somewhat slow as people were still adjusting to new economic realities. There was less certainty about direction of the economy, likelihood of recession, and the extent of Federal Reserve's rate action. However, the activity seems to have picked up, and today the volume seems to be only trailing slightly behind 2022. And we had a couple deals just in the last 2 weeks coming to the market, with the second ABS issuance by John Deere in 2023, and the new transaction from Amur Equipment Finance. Interesting observation, or curious observation, that in 2023, independents are slightly less proportionately represented compared to captive, bank, and insurance sponsors of equipment ABS, with, by my count, 5 independents versus 9 captive, banks, and insurance companies completing ABS deals year to date, compared to 14 to 17 ratio in 2022. So one may say, at least up till now, independents carried a little bit less, contributed a little bit less to the volume or deal count in terms of issuance this year. As for the second part of the year, I do not have a crystal ball, but I think we may expect a fair amount of activity now that the people sentiment towards likelihood of recession is much more subdued, as well as at least market sentiment is that understanding of the upcoming Federal Reserve action is clearer, or the picture or expectations are clearer than they were in the beginning of the year. That being said, on the backdrop of today's GDP news, the rate for certain treasury rate for treasuries, for certain treasuries, for certain maturities jumped on this news because the market participants are concerned about the economy overheating and Fed maybe overdoing it vis-a-vis the expectation. That being said, I think we're still operating within the greater clarity compared to the beginning of the year, and should see a fairly active second part of the year.
Thank you, Sergey. Now, in terms of our portfolio of ABS ratings across equipment leasing, maybe you can give us an update on what we cover and your thoughts on our portfolio.
Sure, Stephanie. Good afternoon, everyone. So DBRS Morningstar has been actively rating equipment lease and loan transactions going back to 2010, and that covers a myriad of asset classes or subsectors within equipment. For one, you have the small ticket portfolios, which are primarily backed by smaller balance collateral types such as office equipment, and then the larger ticket transactions, which are backed by transportation and ag equipment. Within those portfolios, there's a difference between granularity. So small ticket portfolios are much more granular, but within large ticket, we do see some portfolios that are concentrated from an obligor perspective. Furthermore, as Sergey mentioned earlier, there has been less independent financing companies tapping the ABS market. So historically, DBRS Morningstar has rated numerous first-time issuers within that independent finance kind of territory. Performance within those transactions that perform within our expectations. As of now, currently, we have 17 transactions with 75 outstanding tranches. Year-to-date performance from an asset perspective has generally been good. That being said, we have seen some normalization in performance that we'll speak to in a bit, but with the economic backdrop and recessionary headwinds, we are seeing slight increases in delinquencies and losses. But that being said, year-to-date, we've only seen confirmations and upgrades across our outstanding portfolio.
And with that, that was a great segue into our next slide, where we kind of get into the what I call the meat and potatoes of the equipment leasing snapshot, which shows underlying collateral performance trends. Sergey, so let's talk about performance in equipment leasing ABS. As I mentioned previously, we published our equipment leasing snapshot that enables investors to see the underlying collateral performance across our rated universe with these variety of different issuers. In terms of 60-plus days delinquencies, what are your main observations?
Yes, as Dew pointed out, all transactions have performed and continue performing within expectations. Of course, we clearly see some increased stress related to the ongoing recession in the transportation sector, which directly affects performance of some transactions which are more prominently exposed to the transportation industry. That being said, the sector has always been highly cyclical and somewhat volatile in terms of historical performance, so that is to be expected to a degree. We will keep an eye on developments. For example, some industry observers point out that the sector, the transportation industry, the transportation sector might have or will in the near future touch the bottom, and things would be expected to be picking up. Remains to be seen. In the meantime, we will continue to observe how things are unfolding and what kind of other effects the stress in transportation industry may have, specifically used values, used resale values, collateral values, etc. As for the remainder of the covered universe, one broadly observed phenomena that I want to mention is quote-unquote normalization. And that's the word you hear a lot when you talk to market participants and originators. It means that when you look at the delinquencies and loss metrics, you see them trending up, but they are increasing from historically abnormally low levels. Think about the levels observed across the industry in 2021. Any industry, including transportation, performed remarkably well within the equipment universe, generally speaking. And if you look at the left axis on slide 4, for instance, the 60-plus delinquency level remain by and large at very manageable levels. Watching the roll rates to later stage delinquencies will be the key going forward for us in determining whether we are experienced normalization or a more profound change in performance trend.
Thank you, Sergey. If we examine 90-plus day delinquencies, we can see from this slide that they are notably lower when compared with 60-plus days delinquency rates. I would love to hear your thoughts on this observation.
Yeah, so the 90-plus day per story is somewhat interesting. When you look at this chart relative to the 60-plus day, I think a couple of things that you want to look at to see where performance trends are shaking out. With the lower delinquency buckets or late stage buckets, there's two things that can generally happen. One, you see early delinquencies not rolling through to the later stage buckets, or the latter, where you're seeing 90-plus days roll through at a higher rate into technical default. That would suggest that there's more severe asset weakening and leading to higher defaults. We haven't seen that yet. Now, as Sergey noted, we are seeing some normalization of performance, and that's the theme that you'll kind of hear throughout this presentation is normalization. We were coming from all-time lows, so now we're seeing delinquencies and losses kind of trend upward. That being said, it's been minor upticks across, and again, impacted across certain sectors more severely than others. So transportation and construction are areas that we're kind of watching closely, and we are seeing slight asset deterioration. But what we're seeing right now is more of 90-plus days having limited roll rates from early stage to late stage. One thing that we do on a consistent basis as part of the surveillance process is we develop internal screeners so that we can track where delinquency buckets are trending if they're rolling through to technical default. That helps us stay on top of the portfolio in case that we have to do further analysis and call servicers to get an update as to what is driving some of these performance trends. So over the next 6 months or so, we will be actively watching our portfolio for roll rates as well as increasing defaults.
And with that in mind, we've seen that delinquencies have remained relatively in check, but in those instances where we have seen credit deterioration, what are we seeing on the losses side?
Great question. So I would say across both small ticket and large ticket, we're seeing some normalization in performance. Within the Large ticket, I think that's where we're seeing the most stress, and that's primarily, again, associated with transportation and somewhat construction. Transportation has always been a very cyclical industry, and currently it's experiencing stress as spot rates as well as over-the-road demand has declined. That has negatively impacted trucking fleet business. But that being said, relatively low, we're monitoring that, the performance trends there. That could also lead to higher defaults and lower recoveries as there's more equipment that is being brought back into the secondary market. So recovery rates have also declined slightly. From the small ticket transactions, historically that has always experienced higher losses than large ticket collateral, primarily because the obligor base is a little weaker from a credit profile perspective relative to large ticket transactions, and just the collateral value. Small ticket transactions such as office equipment does not hold value like a combine or a Class 8 truck. So you have that dynamic that's impacting the small ticket portfolio. That being said, we're seeing moderate increases in CNLs. We're actively monitoring the portfolio on a monthly basis. All of our outstanding transactions have been deleveraging, which has resulted in increasing credit enhancement levels. The year-to-date performance has been generally resilient, and we've only seen confirmations and upgrades within our rated portfolio and no negative rating actions.
Thanks, Stu. It seems like we have some stable rating performance in equipment leasing ABS. For this next question, I want to shift gears a tiny bit. Green investing has become more of a focal point over the last handful of years. Back in August of last year, President Biden signed the $737 billion Inflation Reduction Act into law, marking the most significant action that Congress has taken in clean energy and climate change in U.S. history, with $369 billion alone in federal monies dedicated to these climate-driven initiatives. They have the 40-30 and 80-50, which basically means we need to cut carbon emissions by 40% by 2030 and by 80% by 2050. I'd be curious to hear from either Sergey or Du what your thoughts on the implications that the Inflation Reduction Act might have for the equipment leasing sector.
I can chime in here, Stephanie. To my knowledge, we haven't yet seen a pure green, quote-unquote, equipment finance ABS today, but well, I can think about equipment financing related to, for example, construction projects involving EV batteries for cars, financing of equipment as well as construction related to semiconductor plants. Historically, for a long time, for example, the biofuel refineries and biofuel industry existed and also required equipment to be financed. So if you look around, this green financing and equipment sector could be all around you. One interesting example I could give you is that one piece of collateral I had seen in the past in a large ticket equipment deal was the underwater unmanned vehicles that could be used to inspect the offshore wind turbines, which were planted to the seabed. So with so much money allocated to various green initiatives, I'm sure there will be plenty of opportunities for equipment lessors as well. And anecdotally, talking to originators, many of them point out to that they see the effects of all these government-sponsored investments as well as investment initiatives kind of being reflected in demand for financing, for equipment financing.
And Du, maybe you want to jump into as well? Do you have anything to share?
Sure. You know, the whole green initiative, it's been around for quite some time. The EPA has began placing greater standards and was more strict with regards to transportation and ag equipment. So in the past 5 or 7 years, EPA has demanded that transportation and ag equipment become more fuel efficient, better, you know, for the overall green initiative. Now we've seen that happen somewhat slowly. So in effect, it really hasn't impacted ABS transactions because we're not seeing a glut of this, so to speak, more fuel efficient equipment coming to the market, which would then depress the, I guess, less fuel efficient equipment that is sitting there in auction lanes, et cetera. So from a recovery rate perspective, we haven't seen that. Now, again, I think that transition will continue over the next couple of years, but the adoption rate of that has been relatively slow. As of now, I'm not seeing any potential negative impacts with regards to outstanding ABS transactions. We'll have to evaluate how, that type of cloud performs when it becomes a large portion of our transactions. But today, I don't see any negative impacts as of yet.
And my outtake on this, based on the conversations with some originators, is that maybe electric trucks are probably still some time away, especially the over-the-road long-distance trucks, unless some revolutionary battery technology somehow emerges. Most likely, I hear that the first application of electric trucks may occur, and that's where we will probably start seeing it on a shorter haul missions, for example, transporting container box from the port to the transshipment point or something of that nature.
Correct. And I think just technological obsolescence, that's always been a topic that we discuss here internally. It just hasn't come to fruition, right? It hasn't really impacted ABS performance because I think one primary driver is the term of leases and loans within equipment are generally small. So within a 5-year window, you generally don't have significant technological advances that would make existing equipment obsolete.
Thanks, Sergey. Thanks, Stu. This brings us to our last question. And we've seen, relatively benign performance across equipment leasing ABS during the first half of this year. But what is our credit outlook for equipment leasing ABS for the remainder of this year?
Well, in terms of issuance, as I said earlier, we expect quite active second part of the year, albeit the uncertainty as to further Fed actions and the direction of the economy still remains. The origination volume so far has been slightly higher year over year compared to 2022, which should support more ABS financing activity for the remainder of 2023. Larger themes from the credit rating perspective on the asset side to watch for us include the aforementioned correction to historical mean in performance, as well as cooling off of the used equipment prices, extent of the resale values drops, and like I said, on direction of transportation and even to some degree construction industries going forward.
Yeah, and from a ratings perspective, we expect generally stable to positive rating actions for the remainder of the year. As Sergey noted, those are some of the metrics that he mentioned. We'll be actively monitoring those trends. We do expect normalization to continue. Now, if we go into a more severe economic recession, I think that's where we'll really have to ratchet up our screener process on a monthly basis. But I think the part that gets us comfortable is the fact that most of our transactions have been deleveraging, resulting in increasing credit enhancement, which should offset for the potential for higher than expected increases in delinquencies or losses over the course of the year. But again, we will continue to actively monitor the portfolio and take rating actions where necessary.
Thanks, Sergey. Thanks, Stu. This concludes our prepared remarks for the webinar. Now we will open the discussion up for Q&A. Again, you should see a question mark either on the side or bottom of your screen, which you can click on and type out your question. We'll give folks a few moments to get them in, and I'll just take a look to see if we have any that came in throughout the webinar. Okay, I see one. It says, I saw an announcement this morning about the publication of an updated methodology for equipment leasing. Were there any significant methodology changes? And maybe Sergey, that sounds like it's for you.
Yeah, very, very timely question. At this point, no, we maintain our methodology without any material changes. As is the methodology, as some of the listeners on the call may know, the methodology can handle both large, mid, and small ticket collateral. We apply different analytical approaches to rating large ticket, for example, equipment ABS and small ticket equipment ABS, but both are covered in detail in the current version of the methodology. And until we see any new market developments that warrant major changes, I do not anticipate any material revisions in the near future.
Great. Thanks, Sergey. Let me just check. Any other questions? Last call for questions. Okay, I believe we have addressed all the questions that were posed. We want to thank every one of you for taking time out of your busy day to spend with us. Special thanks to Sergey and Du for joining us and sharing their invaluable insights on the equipment leasing ABS sector. As a reminder, we published our inaugural equipment leasing snapshot, which has all the charts that you saw here and even more detail with bullet points on our main observations. So I encourage everyone to please take a look. It'll be probably provided in a follow-up email from our team. And as a reminder, this webinar is being recorded and will be available for playback should you wish to revisit any discussion points or perhaps share the replay with your colleagues. Thank you again for joining us and enjoy the rest of your day.